We actually had a situation on Thursday where we had to, in the Fifth Third Treasury Money Market Fund, we had to suspend new purchases. Now, as a money manager, the thought of telling someone they can't put money into my fund, okay, is pretty abhorrent. I get graded in sense, from a performance standpoint on growing assets. So all of a sudden, I've got $600 million that wants to come into a $2 billion fund, but I've got 21 basis points of embedded fees on that fund. I could not get a yield on a Treasury bill from overnight to out 3 months that was higher than 15 basis points. So the second I purchased it, given my embedded fee, I was losing money for my existing shareholders. Now, we would allow anyone to take money out of that fund, but believe me, nobody wanted to get out of a Treasury money market fund on that day. So we actually had to suspend for 1 day and 1 day only new purchases until the Treasury came in, pumped almost $200 billion in new bill supply into the marketplace, and yields rose to a princely 40, 50 basis points, and we could actually invest the money, quote unquote, profitably for our shareholders. But if you want an example, if you want the easiest example to understand about how dysfunctional the markets have become, fear and paranoia coming to the point where you take an actual loss on a security just to know that you're going to get your money back from Uncle Sam in the space of 3 months. One good way to look and measure what we're dealing with right now in the crisis, and this is a very straightforward way to do it, it's something called the TED spread, Treasury over Euro-dollar spread. Now, we can basically reduce the financial markets right now to a decision that a bank can make. It can, if it's got its capital, it can choose to lend that capital to another bank, okay, or it can choose to basically lend that money to Uncle Sam in the form of purchasing a Treasury bill. So given that decision that a bank has, choosing between these two, where is it going to put its money? If it goes with LIBOR, okay, LIBOR, the London Interbank Offered Rate, okay, that rate's set every day. And it basically looks at 4 large banks and where they're lending money between each other, and that rate's struck. During normal times, and you see the line down along the bottom there, if, say, Treasury bill rates are at 3%, a bank can choose to lend its money out for 3 months to another bank for around, say, 3.25%, 3.30%, 3.40%. An additional spread, but in periods when everybody sees the markets as being okay, you pick up that incremental spread because there's not a lot of risk in the financial system. Now, when we go through a crisis period, all of a sudden you don't trust who you're going to lend to. Okay, you don't trust the other bank. You want the absolute safety and security, so you choose to instead go to a Treasury bill, a risk-free security. Okay, so 2 things happen there. You get a lot of demand going in. The yield goes down on the Treasury bills, and because there's not a lot of money being placed in the interbank market, yields go up there. So this LIBOR spread blows out. And when that spread gets wider, it's very indicative of periods of financial stress and crisis. So historically, we can look back and see that the spread in terms of long-term capital management, quote-unquote, blew out to almost 100 basis points. Treasury yields fell, LIBOR rose. Back in long-term capital management, Y2K, remember that? We almost went up to about 140 basis points. Enron, WorldCom, every CEO is a crook. Okay, LIBOR blows up. But look at how quickly the markets recover. This financial crisis, if you look at it, we have been elevated for an extended period of time, and at levels much higher than we've ever seen during any previous financial crisis. And if you look at the TED spread today, that number actually is up around 340 basis points, almost 3 times the previous level for the TED spread. So a great indicator for the financial stresses still at play in the marketplace. Finally, where this all comes in, okay, where we're talking about the losses in the financial system and the need for a fund to come in on the part of the Treasury and essentially start buying up these assets. We're not talking bailout here. We're talking about getting the capital markets moving again. The upper left-hand corner there, and that number should actually be about $551 billion. The financial system has taken write-downs of around $550 billion in terms of mortgage-backed, mortgage-related type assets out there, and they've only raised capital of about $352 billion. So we need $200 billion of capital to really recapitalize the banking system and get lending going again. Because as it stands right now, banks are trying to hold on to money and not be willing to lend it out because of the losses they've suffered and the capital they need to rebuild. So that's the real issue here, okay? If banks aren't willing to lend to each other, as seen by the rise in LIBOR and the blowout in the TED spread, folks, they're sure as heck not willing to lend to you, or lend to your business, or lend to the local government, or whatever. So now you get a credit crunch. And as that credit crunch goes on, now we have to start talking about the impact of the overall economy and to individual investors.
Thank you, Mitch.